Hello, everyone. It's great to be here today. My name's Casey Kaplan. I'm the Chief Commercial Officer at Carrington Labs. With me, I have my colleague, Marco Grill. At Carrington Labs, we work with lenders, and we produce explainable, AI-powered credit risk models. We use a much broader set of data, so we can make better default predictions. Now, I have been speaking with financial institutions and lenders for close to 20 years now, and a common theme has always been there's so much data, but these organizations don't have the capacity or the capability at times to fully utilize it. At Carrington Labs, we can ingest all types of data, so traditional data like your loan tapes, bureau scores, application data, but also alternative data like line item transaction data and behavioral data. From there, our AI generates tens of thousands of candidate features. We test those for default predictiveness and then build a tree-based model that normally has around 500 features. And we do this for each loan product you have, for example, a personal loan and an auto loan. This allows you as a lender to uniquely understand the risk profile for each customer for each loan type they might be applying for. Ultimately, this can help drive revenue and improve your contribution margins. So as we jump into the platform, I want to point out that everything is API driven. So although we're showing you a portal today, everything you see can integrate into your existing loan origination system so that you can make real-time lending decisions. So what we'll first do is jump over to an individual user's profile who has applied for a personal loan. We've ingested the data, we've created the model, and we now can see the risk rating for a specific borrower. It starts by optimizing towards the probability of default. So in this case, we see a PD percentage of 1.2%. And then we assign a product-specific risk score. So a 1 is least risk, 100 is the most risk. And to make it easier for lenders, we can then index the product-specific risk score to an existing credit score range you might be using, for example, 300 to 850. Because explainability is important, for each user, you're able to see which features in the model positively contributed to the risk score, as well as detracted. And then you can see how this user compares to the overall portfolio. This is really, really valuable. It gives you as a lender the ability to make better decisions. So for example, one way you might be able to use the risk score is to set a financial target. For example, it might be a default rate, it might be a margin number that you're trying to achieve. From there, we can make a recommendation saying if someone has a risk rating of, say, 80 or below, you should approve them. If it's above 80, they might be a high-risk user that you want to look into a little bit more. And if this was the only thing I was going to show you, I think there's some value in it. But what we're about to show you, I think we are the only company in the world doing it. I haven't seen anyone else do this. We are able to map the elasticity of default, so we can show you the default elasticity for each loan product on a user-by-user basis. So if we look at this in 3 dimensions, what we're able to see is if you take the loan amount, the loan duration, and the default rate, that 3D surface area is the default elasticity. If we look at this in 2 dimensions, it's a little bit easier to understand. So the green bars here are Merrymaker charts. So the width of each bar represents the volume a lender has done at that dollar amount. So in this case, we see quite a few loans around $30,000, but not as much at $5,000 or $50,000. The blue line is just a fitted line showing the default rate. And then the yellow line is the contribution margin. Now, most lenders are normally trying to optimize to improve their contribution margin. And obviously, as you lend out more money, you're generally going to generate more revenue. But you tend to hit a point where if you lend out too much, someone's not able to repay you, and that default rates are going to go up, which erodes margin. So what our platform is able to do is figure out what is the optimal point to lend at based on a lender's risk appetite and objectives. So in this case, the model is set up to optimize towards contribution margin and lifetime value of the customer and be slightly more conservative. So the model is recommending $30,000. Now, if we jump into a portfolio view and our admin setting, you can see that you can support different types of loan product constructs. So here we've loaded up some personal loans and auto loans, but it's quite flexible in terms of pricing and constructs that we're able to support. And when we look at the model performance, you're able to see across the portfolio for that specific loan product what is the most predictive and how do you anticipate it to perform? So you can see which features are positively and negatively impacting the model the most. We know when it comes to AI, explainability is very important, so we have PDP charts. What that is showing is it's showing the significance of one feature while holding everything else constant in the model, as well as another load of metrics around the expected uplift you can get from using the model, which has been trained on your historic data. And for those of you who are more financially inclined, we can also demonstrate through a waterfall chart the expected uplift. So because our models allow you to understand risk better, in particular if it comes to thin file customers, underbanked customers, you're generally able to approve more applications. Because we can understand the default elasticity, you can really optimize the loan limit that someone might have. So an example of that might be someone applies for a $25,000 loan, and our system says, well, based on the margins that you're trying to achieve, really they're only creditworthy for $20,000. Or if you're trying to pre-qualify someone, you might say they're actually good for $30,000. And since loan portfolios are generally evaluated on a dollar-weighted basis, it really helps you out as a lender maximize that margin. And then finally, pulling all of that together, it's going to bring down your default rates, ultimately leading to an improved contribution margin. Now, we are very excited to work with lenders. We can support various types of loan products. So far, we have had millions of loans run through this platform. It has originated and supported the origination of billions of dollars. And we look forward to having conversations with you later today. Thank you very much, and thank you to the whole Carrington Labs team who built this amazing platform.